Good evening, class. You are all welcome to today's class. Today we'll be looking at accounting for inventory. Accounting for inventory. Inventory management is a very important aspect of an organization. Management decision-making process and accountants play critical role in ensuring management team get accurate data as regards planning and control. Inventory has to do with stock. Procedures and documentations of materials. Any purchase of materials from a supplier should be properly authorized and approved at the appropriate management level. So before any purchase of materials will be made, there should be an appropriate authorization and approval by the appropriate management. The store department cannot decide on their own to make purchases without authorizations from the management. Then the receipt of materials from a supplier should also be documented. The receipt for the goods purchased from suppliers should be documented. They are source of data. They are also source of data to the organization that will be used to provide information to management for decision making. Then the receipt, make sure that the goods order were delivered. You will check the receipt against the goods delivered to make sure that what has been ordered for is what is being delivered. There should be an invoice from the supplier for the goods that have been delivered. So now the suppliers of this raw material will send invoice to the organization. Then when materials are received from a supplier, there might be held in a store or warehouse until needed. So when goods are supplied, they are first taken to the warehouse. They will be kept in a warehouse until when they are needed. So when they are needed, they will now be issued from the store. There should be a documentary record. This documentary record will show the receipt of this material into the store. And then also, when these materials are being issued out, there should also be a record. The quantity that is being issued out and to whom this material is being issued out to. And for the purpose of issuing out the materials. Then the next thing is procurement procedures and documentation. The process you follow to carry out procurement and the documents required. The first is the initiation of the procurement. At the procurement procedures, the number one thing is the initiation of the procurement. First of all, it will be determined that there is shortage of such materials by the store to the management. Then the management will now carry out the necessary things. So the initiation of the procurement will start from the store department. Then selection of supplier and raising the purchase order. Then the next thing to follow is to determine the supplier who will supply these goods or raw material. If the supplier is determined, then the next thing now is the purchase order. They now raise the purchase order, ordering for the supply of these items. Then inbound logistics and verification. When the goods are supplied, taken to the store, then now there should be verification. The goods ordered for, were they the goods that were supplied? The quantity, the quality, all these will be checked. Then the next thing, document matching and invoice verification. Match the documents and the invoice. Matching the documents and the invoice. The next thing that will follow is matching the documents and the invoice. To check, to make sure that the documents, the items on the document match the items on the invoice. That is how you carry out the verification. Check the documents to make sure that the items on the document match the invoice. Then the next thing is the accuracy of quantity received. You now look at the quantity ordered for. Is it the same with the quantity received? If you order for 200 quantity and you receive the same 200, then that shows it is accurate. Then the next thing is conformity. When you are matching the document with the invoice, you check the accuracy of the quantity received. Then the next thing is conformity to purchase terms. Is the purchase terms followed? The agreement made during the purchase, is it followed? Then authorization, authorized pricing and payment terms. Authorized pricing and payment terms. You now check the authorization, the price, cost in the supply, and then the payment terms. The payment terms. Then this is the purchase process. This is how the purchase takes place. This is the purchase process. First of all, is the purchase requisition. You make a request. The purchase requisition is the first thing in the order, followed by the purchase order. When the requisition is made, then the order now will be made. Purchase order. Then the next thing is the delivery note from the supplier. The supplier will now send a delivery note. Then the next thing is goods received. Goods received. When the goods are received, you now send the goods received note. The goods received note will now be sent. Then the next thing is purchase invoice. Purchase invoice. Then the purchase invoice will follow. Then this is the purchase process. This is how purchase takes place. This is the purchase process. You make the purchase and the goods will be supplied to the store. And when they are kept in the store, that is where the inventory starts. They will take the stock, take the inventory of this goods supply, and then they will not control these goods, this inventory in the store. Total amounts received will be recorded. The quantity of goods issued out will also be recorded for control purposes. Then the next thing is accounting for inventory transaction. Inventory transaction. How do you account for inventory transaction? That is the next thing we'll be looking at. Inventory accounting for inventory transaction. Number one, in the store department, that's the store where the inventory is kept. In the store department, the materials should be kept secure. Make sure that it is secure. And there should be systems, processes, and controls to prevent loss, theft, or damage. This is how you account for inventory transaction. You make sure that the materials are kept secure. And there should be a system, processes, and controls to prevent loss, theft, or damage. The stores department should keep the store department should keep a record. The store department should keep a record of all inventories. Then the second, a record of the quantity of each item of material currently held in the inventory. So the next thing, in the cost accounting department, we've seen the store department. So the next one now is the cost accounting department. Another separate record of inventory might be kept with an inventory ledger control for each item of material. So now the cost accounting department will also keep records of inventory. So that at the end of the day, you can check between the store and the cost accounting department. The inventory ledger record is a The inventory ledger record is a record of the quantity of the materials currently issued, held in inventory. The ones issued or the ones held in inventory, they are recorded at the cost accounting department in ledger. So this can also serve as a backup in case if the store department did not keep the proper record, at least the record will be found in the cost accounting department. But the store department is expected to also keep proper records of inventory, the ones received and the ones issued. Then in a computerized inventory control system, the store department and the cost accounting department should use the same computerized record for inventory. So where the organization use computerized inventory control system, the cost accounting department and the store department should use the same computerized records. So that the information will be accurate. The same information that can be obtained in the store department should be the same information that will be seen in the cost accounting department. When items are received, they will record it. When items are issued out, they will record it. The quantity received and the quantity issued. Documentation for issuing and returns of materials. So the documents now used in issuing materials from store. A materials requisition note. If you want to receive materials from store, if you want to collect materials from store, that's what we call material requisition note. It is that material requisition note that you will fill. And in that material requisition note, you will describe the type of items you want to take from the store and the quantity. This is a formal request from a user department. This is a formal request from a user department to the stores department for quantity of an item of materials. So the department that need this material to use will now fill this material requisition form, take it to the store department with the quantity of the materials they need. Then the store department will acknowledge and issue this material to the user department. Then B, a material return note. That is another document that is being used in the store. Material return note. When items are returned to the store unused, the store department should record the return on a material returns note. If, for example, you collect 200 quantity of items from the store. And at the end of the day, you only use 120 of these items. You are returning 30. You are returning 30 back to the store. So when returning this 30 back to the store, this material return node will be completed, will be filled. Then the next thing is the valuation of inventory. How do you value inventory? How do you carry out inventory valuation? Now we are going to see how to carry out inventory valuation. How do we carry out inventory valuation? How do we value inventory? So there are basic rules. The basic rule of valuing inventory is lower of cost or net realizable value. Lower of cost or net realizable value, which is also known as the NRV. Inventory valuation is a critical aspect of financial accounting due to its direct impact on the cost of sales, and gross profits. So it is important and it is very critical, the valuation of inventory in financial accounting. If you carry out wrong valuation, it will affect the cost of sales and gross profit of that business. If you overvalue it or you undervalue it, it will affect the gross profit. It will either overstate or understate the profits. And the valuation of current assets in the statement of financial position based on the GAAP, generally accepted accounting principles, GAAP, and the International Accounting Standard 2, IAS, inventories must be stated at the lower of historical cost. This is the provision of these standards in GAAP and the International Accounting Standards 2. Inventories must be stated at the lower of cost, of historical cost, or net realizable value. So now you'll be seeing how to determine a net realizable value of an inventory. This is an example. A business has 4 items of inventory. A count of the inventory has established that the amount of inventory currently held at cost are as follows. The historical cost, the cost of the inventory, cost of item A, A1, A2, B1, and B2. The cost from 8,000, 14,000, 16,000, and 6,000. Then the sales price. The sales price is 7,800, 18,000, 17,000, and 7,500. And there is selling cost. There is selling cost. The selling cost of 500, 200, 200, and 150. About net realizable value. You are going to take from the cost. If there is selling cost, you remove the selling cost. If there is what we call, if there is any impairment to the items in the store, you will remove it. So what you will come up with as the net realizable value is what the asset, or sorry, what the inventory will worth at that particular time. If you are to sell that inventory, how much are you going to sell it? So it is the net realizable value. So you value it at the net realizable value. Like in this case now, if we want to value this The net realizable value, we will take the sales, we remove the selling cost, and then we'll get the net realizable value of this. We're this inventory. This is the requirement. Calculate the value of the closing inventory. So we're going to calculate the net realizable value of this inventory. So to determine the closing inventory for this account, you will set the closing inventory that will be on the financial statement will be so we have the items in A1, A1, A2, B1, B2. The cost for A1 is 8,000. The cost for A2 is 14,000. The cost for A3 is 16,000. The cost for B is 6,000. So this is the historical cost of this inventory. But now, what is the net realizable value? The net realizable value, what is the selling price of the item? Hello, class, are you with me? Can you all hear me?
Yes, sir. Yes, we
Okay,
can, sir.
that is good. So now, the selling price for the inventory A1, the selling price is 7,800. That is the selling price. The cost of the item is 8,000. The sales price is 7,800. So to value this inventory now, you will say the 8,700, 7,800 minus 500, the selling cost. So this will give you the net realizable value. So 7,000 minus 500. 7,800 minus 500. You have 7,300.
200.
7,300. So this would be the closing value for item A1. Then for the H, for inventory H, have 18,000 minus the 200 sales. So 18,000 minus 200. 18,000 minus 200 is what? What is the value? Hello? Can you hear me?
Yes, sir.
18,000 minus 200. Don't you have calculator there? Is 17,800, right? 17,800. Between 17,800 and 14,000, which one is lower? 14,000 is lower than 17,800. So the lower of cost here is the 14,000. Then the next one is 17,000 minus 200. 17,000 minus 200 will give us 16,800. And the cost of 16,000 and the 17,000 and the 16,800, which one is lower? 16,000 is lower. So you take the cost of 16,000. Then the next one, we have 7,500 minus 150. So 7,500 minus 150 will give us 7,350.
7,350.
Thank you, 7,350. So between 7,350 and 6,000, which one is lower?
6,000.
So you are taking the lower cost, you will take 6,000. If you look at it, that is what the provision here says. It says based on gap, generally acceptable accounting principle and international accounting standard. Two, inventories must be stated at the lower of historical cost or a net realizable value. So this one now, the lower of the historical cost. This is the historical cost. Compared with this, the lower now is what we will take between the lower cost and the net realizable value. So now the lower, this is the lower cost. So the total, if we add them together, what are we going to have? 7,300 plus 14,000 plus 16,000 plus 6,000.
43,300.
43,300. So this is the value of the closing stock. Now, if you're preparing financial statement, this is what you use as the inventory. So do you understand this? So this is how you value inventory, the lower of cost. Do you understand this?
Yes, sir.
Okay, so this is how you determine it. So the next thing, inventory costing methods. Inventory costing methods. First in, first out, which is also known as the FIFO. The first items to receive, this method is saying the first items you receive into the store will be the first item you will issue out. The first item you receive into the store will be the first items you will issue out. First in, first out. Assume that the earliest purchase items are issued or sold first. Then the next one is the weighted average cost. Weighted average cost, WAFCO. weighted average cost, uses a moving or periodic average cost per unit. So this one uses a moving periodic average cost per unit, recalculated after each purchase or over a defined period. Always find the average on a periodic form. Then the last one is last in, first out. Last in, first out, which is also known as the LIFO. The last item to receive will be the first item to issue out. That is LIFO. This assumes that most recent purchases are issued first. That is what it means. The items you receive last will be the items you will issue out first. So LIFO is not allowed under International Financial Reporting Standard. So that means it's no longer in use because in preparing financial statement, we use International Financial Reporting Standard. So for costing your inventory, you can use first in, first out. You can use weighted average, but last in, first out is not allowed. But under the US GAAP, they still use the LIFO. The US GAAP, the US generally accepted accounting principles, they still use the LIFO method of costing inventory. So let's see this example. This is an example. Let's look at this example. On 1st January, the company has an opening inventory of 100 units. The opening inventory is 100 units. And this 100 units, which cost 15 naira each. So each of the 100 units costs 15 naira. During the year, it made the following purchases. So it has an opening inventory of 100 units that cost 15 naira per unit. And then during the year, they made the following purchases. On 5th April, 300 units at 16 naira each were purchased. Then on the 14th July, on the 14th of July, 500 units of items at 17 naira each was purchased. Then 22nd October, on 22nd October, 200 units again, 200 units at 18 naira each was purchased. Then during the period, it sold 800 units as follows. This is how the 800 units was sold. On the 9th of May, 200 units was sold. 25th July, 200 units was sold. 23rd November, 200 units was sold. And 12th December, another 200 units was sold. So now we are going to look at the three methods in solving this question. We'll look at this in this illustration using the three method. The first in, first out, FIFO, the weighted average, and the last in, first out. Now let's look at it. Let's create our table. We start with the quantity. Then we can see price per unit or cost per unit, price per unit, price per unit. Then the total the total price, the total, we will have it. We have the total. Then in this form, we have the quantity again. After the quantity, then issue. We have issues, the quantity issues. Then we have the amount. The amount. Then we have balance, what is remaining. Then the total of the balance remaining. So look at this. The first date. The first date here is 1st January. On 1st January, a company had an opening inventory of 100 units, which cost 15 naira each. So the first date here is 1st January. We have 1st January. And on this 1st January, we have 100 units. Our opening balance is 100 units. We have 100 units, quantity 100. And the cost of this unit is 15 naira each, 15 naira per unit. So we have 15 naira here. So now to get the total now, we'll say 100 units times 15 naira. What are we going to get? One hundred times 50, we will have 5,000. So this is our opening stock with hundreds that cost 15 naira. So we have 5,000 value of inventory at the beginning. So the next one is April. In April, in April, in April, 300 at 60 naira. So we come here and we have 5th April, 300 units at 60 naira. So 360. Who has been
18,000.
responding? Good. 18,000. This is the value. 18,000. So now if you look at it, our total quantity in stock for January, the total quantity is still this 100. And then another 300 came in to meet our previous 100 that we have. So these 300 will be added to the quantity we have in stock. Then the total in stock at that period will be what?
400.
400. Thank you. So at that time we have total item in store to be 400. It will be 400. And remember, out of this 400, we did not issue any. So their prices or their remains the same. We still have the cost for the 100 item is 5,000. Then for the 5th April for the 16th is 18,000. Sorry. This is still, let's me still have the price per unit. Yeah. Okay. Still the price per unit. So it's still the same 50 for the 100 and 60. So the balance we will have here will be 150 is still the 5,000. Then 360 is 18,000. So the total we are going to have will be 5,000 plus 18,000.
$23,000.
Thank you, 23,000. So this is the value of our inventory as at 5th April. So the next thing now, let's take a check. The next item, the next item from the question, the next thing that comes after April is May. So during the period, they sold 800 units as follows. So out of this 800, 200 was sold in May. So now we are going to take 9th May. On the 9th of May, on the 9th of May, 200 items were sold. So now if we come back here, since it's since on the 9th of May, 9th May, okay, on the 9th of May, 200 items were sold. And remember, we are using FIFO now. First in, first out. We are using FIFO method. So now if this 200 that is sold on 9th May, we will first of all set the opening inventory of that 100. We will finish that 100 before we will come to that of April. So now the first 100, the quantity 100, that's the quantity issued. We issued 100 quantity, and this 100 quantity comes from the January inventory, which was 15 naira. So this 100 will be at 15 naira. Then the remaining 200, the remaining 200, sorry, the remaining 100, since total is 200, 100 and 100, the other 100 will fall under the 300. So we have 200 here, and it costs 60 naira. So we'll have it at 60 naira. So now, sorry, let me close this. So now the total issue is 200. The total issue for this period is 200. Two hundred quantity, 200 units. And at the price of 150, this one is 5,000 still. So the 5,000 is gone. So, and then this one is 160. 160 is 6,000.
1,000.
Yes, 6,000.
So 23,000. 12,000.
100 times 60,
6,000.
6,000. Thank you. So it will be 6,000. So the next thing from from the from the total inventory that we have of 400, total of 400, 200 is issued out. From the total of 400, 200 is issued out. So what will be the balance?
200.
200. So we will be left with 200. So any item that is coming now will hit this 200. We only have 200, and the 200 is the 200 costs 60 naira because the 200 is part of this 300. So it costs 60 naira. So the next thing now we will take which month comes after the May transaction after the May. It is the July. After May, we have July. And this July is 40. So we now come to the table. The next thing is July. We have, sorry, what is the date? 14th July.
14th July.
Oh, okay, thank you. 14th July. And in 14th July, 14th
500.
July, okay, let me even have it 200. Let me remove it here. Okay, no problem. Still the same thing. Okay, on the 14th July, 700, right? How
500
many
at
pieces?
17 naira. At
500 at
17 naira
17
fine.
naira. Thank you. 500 at 17 naira. 500. We receive 500 at 70 naira. 500 at 70 naira. So now 500 times 70. 500 times 70
35
naira. We have
35,000.
35,000. 35,000. But meanwhile, sorry, we need to add this. 500, 5,000 plus 6,000.
11,000.
We have 11,000. And you know what will happen to this 11,000?
23 will remove the 11,000.
Thank you very much because we paid. Thank you very much because we sold this one out. So it's leaving. So we'll remove it. Let me put it in so that it will indicate. Okay, this is it. Let me good. So now if we remove the 11,000, the 20 to 11,000 from 23,000, what are we going to have?
We have 12,000.
We have 12,000. And this 35 will be added to the 12,000. So when we add this 35 to the 12,000, what are we going to get?
47,000.
47,000. So this is it. And then our total 500, we add it here. So our quantity will be, our available quantity
Seven.
will now be 700. Our available quantity will now be 700. When we add this to this, our available quantity will be 700. Okay. So now the next thing, let's check the questions. The next item we have, after July 14, we have July 25th, right? 25th July, 200 units. 200 units was sold. 200 units was sold on 25th July. 25th July, 200 units. 200 units sold. At what price? The price of the 200 units. Okay,
They did
200 units sold. Yes, okay. So we are going to determine it here. Remember, remember, out of these 300, out of these 300, we have 200 units left.
yes, yes.
So if you are issuing now, since we are using first in, first out, so it is this 200 that will go out now.
O-
Yes,
Okay.
yes. So and what price was it? It was 16 naira, right?
Yes, 16 naira
So
fine.
this 200 will go out at 16 naira. The 200 is going out at 16 naira. We are removing 200. Yeah. So 200 times 60,
12,000.
12,000. So the 12,000, we are also going to remove the 12,000 from 47,000. Let me put it in
We have
bracket. Okay. Sorry. This one, I want to have it in brackets. Mhm. Okay. Good. Good. So we have 47,000 minus 12,000. So what do you get?
35,000.
35,000. So the next year will be 35,000. 35,000. So if you look at it now, we have exhausted the balance of the 200. That is out of the 300. So now if there is any issue, we are going to touch the
45.
500. Yeah, we are going to touch 500 if there is any issue. So now let's see which one comes next.
October,
October. Thank you. It's
2nd
October
of
that's come next. October 22nd. And this one is purchased. So it's received, right? It's received into the store. So 22nd
Yes,
October. Good. So 22nd October is the next. 22nd October. And the amount received is 200 units at 18 naira. So we have 200 yeah, at 80 naira. We have 200 at 80 naira. So 200 times 80 naira.
16,000.
16,000. So this one is received. We received 16,000. So the 16,000 will be added here. So 16,000 plus 35,000.
51,000.
51,000. So this one we add. This one is an addition. It increased. So now we now look at the next one. The next item. Which month? November, right?
Yes,
November
23rd November.
23rd. 23rd November, 200 units. So we come here, we have 23rd November, and the 23rd November is what is sold, unit sold. So that means it's issued out. So we have 200 units issued out. Quantity, November 3rd, 23rd is 200. We have 200 units issued out. At what price?
At 70 naira.
Thank you very much. Thank you very much. At 17 naira, because we are now dealing with the 500, right?
Yes,
Yes. So it's at 17 naira. Good. 17 naira. So 200 times 17 naira.
14,000.
We have 14,000. And this 14,000 is in bracket. It's minus, it's less. We are lessing the 14,000.
Yes, we get 37.
Good.
Sir, please, I have a question, or rather an
Oh,
observation.
okay.
For this 22nd of October, the
Yes.
200 the 200 quantity, we didn't add it back to the balance of 500 that was initially there.
Okay, we're supposed to add it
Yes.
here, right? Uh-huh. So we have
Yes. Yes.
200. Yes, 200. So now, if we are going to deduct this 200, right, from this 700.
Yes. Yes.
Okay, so let's balance it. Okay, so if we do that, we'll have 500 here, right?
Yes.
Good. Sorry, I'm coming. Mhm. Good. So this one here, good. So if we minus this 200, we'll have 500 here, which is right.
500.
So
Yes.
yes. So when we add the 500 to this, we'll have 700, right? 700. So the 23rd November, we are removing this.
Yes.
Good. Okay. So when we remove it, we'll be left with 500, right?
Yes, sir.
Okay. So we have 500 remaining. Thank you. Yes. Okay. So the next thing now is December 12th. That's the last item. No, December 12th, 200 units. So if we come here, we have December 12th. December 12th. And this one too is issued at 200. So and this 200 will be at what price?
It will still be at that 70 because we still have
It will still
300
be because
from
we have
that.
a balance of 300. Thank you. So it will still be 70. It will still be at 70. So 270,
It's 14,000.
270 is 14,000. But before then, let's do this. Let's minus this and get this balance.
We have
51,000. We have 30,
37,000.
30,
37,000.
37,000.
37.
Thank you.
Yes, sir.
Okay. Then this one, 14,000.
Yes. So
Okay.
we have
And then this,
30.
okay. So now we'll remove the 14,000 here. 14,000. Okay. So now 37,000 minus the 14,000. What will be the balance?
23,000, sir.
23,000. Thank you. So we have 23,000. So that is it. We are done with FIFO. First in, first out. We are done with first in, first out. This is how it will come out. So any question on this? Then the next one, we'll look at the weighted average. The weighted average method. Then we'll look at the last in, first out method. So if no question on this, let's look at the weighted average method. Okay. So now the weighted average method. Weighted average. The weighted average method. So we have the date, we have the quantity, we have the price per unit, then we have the total. For receipts, this is the receipt side. Then for the issue side, we have the quantity. We also have the price per unit. After the price, we have the quantity, the price per unit, then sorry. Okay, the issue quantity, the price per unit. Then we have the balance. Let me create the balance. Then we have for the balance, the quantity for the balance. Let's have it here. We have for the balance, the price per unit. Then the total. Okay, so now let's see this using the same question, but using the weighted average method for costing the stock. Okay, so now let's continue. The date, our first date, we still have the January date for the first item to be received into the our opening balance. The opening inventory. The opening inventory is still on 1st January. The company has an opening inventory of 100 units. So we have the 1st January. Quantity 100. Price 50 naira per unit. Total 5,000. 100 times 50. Then on the next one, on the 5th April, receive 300 units. 5th April received 300 units at 60 naira, at 60 naira per unit. 60 naira per unit. So now, then on the 9th of May, on the 9th of May, this was issued. So now in our balance, let's take it, the balance, our quantity for the opening is still 100. Then we receive 300. So our total balance is 400. And for the price, this is 50 and this is 60. And the total is 5,018,000. So now, since we are dealing with average now, what is the average price? Now, we issue it out. Let's look at the first thing. The next thing from the question, after April is May 9, and on the May 9, 200 units was sold. 200 units was sold. So now let's see it. On May 9th, 9th May, issue out 200 units. 200 units. So what would be the price of the 200 units? We are using weighted average. Are we together?
Yes, sir. Yeah, yes, sir.
Okay, so if you want to determine the weighted average, you add the price, the two price, and divide it by 2. We have the two prices here. We have 50. The first one, the opening one is 50 naira, and then 60 naira. So 50 plus 60 divided by 2 will give us what? What will be the average of 60 naira and 50 naira?
55.
Huh?
55.
55?
Yes, because 50 plus 60 is 110. Divided by
Okay,
2 is 55.
okay. So this will be the average. 55. We issue on the 9th May, 200 is issued. We have 50 plus 60. And our inventory, the inventory, we have 100 and 300. 100, 300. So we have 110 and 400. So now we issued 200. New 200. So add these ones for me, please. The issued 200. That is 600, right?
Yes,
100.
sir.
Okay, 100 plus 300 is 400, right? Plus 200,
600.
600. Okay. Sorry, let me have this. Sorry, 300 times 600. 300 times 600 is 18,000. This is how we get this. Then now we are issuing 200. 200 is sold out on the 9th of May. This is 9th of May 200. And the two prices. Sorry, 5th April 360 naira, 15th July 500 units at 72 naira, 15th October, okay. Then 9th May 200 units at the average price now. $200 units at the average price. To determine it, excuse me. Sorry, let's determine the average quantity. What is the average quantity? The average quantity for the two products, the average quantity for the total, this times the cost price for the opening 100 times 50 is 5,000, 300 times 60 is 180. So 5,000 plus 5,000 plus 18,000, we will have 23,000. Confirm it, please. Is it 23,000?
Yes,
Hello?
sir, it's 23. It's 18,000 plus 5,000.
Yeah,
It's
yes,
23.
18,000 plus 5,000.
Yes, sir, it's 23,000.
23. Okay. So the average will be 23, 23,000 divided by 2. 23 divided by 2 will give us what? 23,000 divided by 2.
11,500.
You have 11,500. Okay, this is the average of this is the average for the quantity. This is the average for the quantity. Then the the quantity sold is 200. So let's 11,500 divided by 200. What do you get? 11.
57.5.
So this will take it as the 57
Point
57
five.
point 5. So this is the average price. This is the average price. 57.5. This will be the average price. So 400 times 57.5.
23,000.
Good. So now for this one now is going out. This 200 is sold out. So it's going out. What is going? Okay, good. So this 200 is going out at 57.5. So 200 times 57.5.
11,500. Antonia, can you hear him?
No,
Ah,
I can't. I think we are the only one here.
ah. I guess network. I think
Network.
network has thrown him outside.
Mm.
Sorry, my network. Okay. So 23,000 minus 11,500.
11,500, sir.
11,500. Okay. So the next item after May, after May 9th, the next one is 14 July. The next one is 14 July. 14 July. And the quantity is 500 units at 70 naira. 500 units at 70 naira. At 70 naira. So 500 times 70. 500 units at 70 naira.
35,000.
We have 35,000. Here the balance is 200. And then we now have 500 at 70 naira, which is 35,000. It's 35,000. So the next item is what? The next item is what? Hello, the next item is July 25th.
Yes, sir. July 25th, 200 units.
July 25th, 200 units sold. So when we add this, 11,500 plus 35, what are we going to get?
Right. 46,500.
46,500. I get 46,500. So now we have July 20. We have July 25th. And the quantity is what? 25th July, 200 units sold. July 25th, issued 200, 200 issued. Two hundred issued. Hello?
Yes, sir. I think we lost you for a moment there.
Okay. So the next thing is 200.
Yes, sir.
200 issue at what price? That is what we are going to determine next. The price at which the 200 is issued.
Mhm, sure. Okay, we get the cumulative average.
Good. So now what will be the cumulative average?
Okay, it will be 46,500 divided by 2. Then the amount we get, we divide it by 200. I'm not sure I got it.
This is the cumulative average. Okay, let me see. Did I give you note on determining the average? We just say using a moving periodic average source per unit. You calculate after each purchase or over a defined period. Okay. I did not. So now we are going to put it here. $46,500. What is the average? So now the total of this, look at the average now. 400 minus 200, we'll have 200 as our balance, right?
Yes, sir.
Okay, so now 200 plus 500, what are we going to get?
700.
Here we'll have 700. So divide this 46,500 by 700.
Okay. 46,500 divided by 700. 66.443 or
43.
66
So
point, I'm getting 66.428.
you can approximate it, 62.43.
66.43.
So this will be your price per unit. So the 200 now will be at 66 naira 43 kobo. Do you get this?
Yes, sir.
Okay. So now 200 times 66 naira 43 kobo.
13,286.
13,286. Thank you. So now this one is sold out. So we are going to deduct it, right? So that we will get our balance. So what is the
So we
difference?
get
So
33,214.
33,214. 3,214. So now this is our current balance. So the next
So we
item,
wrote 21. It's 214,
okay,
not 216.
sorry, 214. Thank you. Like this, right?
Yes, yes, sir.
Oh, okay, thank you. So the next thing now, the next thing on the item, let's see what do we have next. After July 25th is what? October, right?
Yes,
And in this
sir.
October, we have 200 units at 18 naira. So now we have October 22nd. This is October what? October 22nd, yes. So we have 200 units received at 80 naira. So 200 times 80. 200 times 80,
10,000.
16,000. Okay, let's balance. We're supposed to balance our account here. We have 200. This 200 is sold out. So we are going to move it here. This item sold 200 units so that we will have our accurate balance. And here we have 200. So this, okay. So 700, this 700 minus 200 is 500. So we have 500 here, right?
Yes, sir.
Good. So this is it. We have 500. This 200 too. This 200, is it receipt of 200 October? Yes, it's received. So this one will be
Receive.
addition. Good. So it will be 700. 700 plus 200. So this one too is received. We are going to have 700. We'll have 700. So now let's see. This, we'll add these two. 33, 214 plus 16,000. 33,114 plus 16,000.
49,214.
Okay, thank you. 49,214. 49,214. Thank you. Okay, so the next item. After October 22nd, the next item is November 200 units. So we come here to November 23rd, November 200 units. We have 200 units sold. So the 200 unit now is at what price?
We'll get the cumulative for it.
Okay. So we already have the cumulative.
Okay.
Yes. So the 49,114 divided by 700 to give us what?
We are dividing 49,214 by 200, right, sir?
Yes. Yes.
Okay, so it will give us 246.07.
Is it 246?
49,214 divided by 200
Yes.
is
No,
200
sorry,
and,
not 200. Not 200. The cumulative is 700. Look
oh,
at
by
it.
700. Oh, okay,
Yes,
yes, sir.
700. 700.
Okay, we are getting 70.31.
70.31. So this will be the average price for selling these 200 items. So 200 times 70.31.
14,062.
14,060 06 like this.
Yes, sir.
Okay, so this one is equals. So we are removing it to reduce our stock at the balance in the stock. So let's do the let's see 49,214 minus 14,062. Let's see what we have.
$35,152, sir.
35,152 like this. Okay. So the next thing now. The next thing.
The last
What is
one is
the budget
December,
of
200 units.
okay, 12 December. So now the next thing is 12 December. We have 12 December. And the quantity sold is 200. So
We
the
sold at
200.
200.
Yeah, sold 200 and it is 200. So now let's have our balance here. Here we will have what? 700 minus 200. We have 500 to be the balance, right?
Yes, sir.
Good. So this is our balance now, 500. So now, for December, December 12th, we have 200 units. And the 200 will be at what price? This one is going out.
Okay. We do 35,152 divided by 500.
No, is there any addition?
No, I'm
Do we
saying
make any?
35,152 divided by the initial 500. Or I'm not understanding. I thought we were doing it with the initial balance.
Yes. What is the initial? Yes, it's cumulative. Go on.
Yeah, so 30, if we do 35,152 divided by 500, we'll be getting 71.
71 approximately.
Yes. So we will now do 200 times 71.
Okay. 35,152 divided by 500. Do it again.
Okay, sir. 35,152 divided by
Divide by
5.
500.
Okay, 70 will get.
Good. 70,
Yes.
70 point
70.3.
70.3. So now 200 times 70.3.
14,060. That's 14,000.
14,000. 14,060 like this.
Yes, sir.
Oh, okay. So what is the difference? 5,000. This one too. We'll find the difference. What is the difference?
21,092.
29,000.
21,000
21,000
090.
like it.
Yes, sir.
Okay. So that is it. We don't have any other item. So any question on this? It will stop here.
I don't have from my end, sir.
Okay. From the other side, any question? If not, we are going to look at. Okay, so let's look at the other one, the last in, first out method. Let's look at the last in, first out. So this one now will say LIFO. The LIFO now. So look at the LIFO. We still have our date. We have the quantity. We have the price per unit. Then we'll have our total. Then the next one, from the issue side, we have quantity issued. Quantity issued. We have price per unit. Price per unit. Then that is the balance. Sorry. We have the total. So for the balance end now, let's also create. We have quantity. We have price per unit. Then we have the total. Okay. So from the same question, our opening inventory is on 1st January and it's 100 units at 15 naira each. The same pattern. We have 1st January, 100 units at 50 naira with a total amount of 5,000 total value. Then this is our opening balance. Then on April, 5th April, the next one is 5th April, 300 units at 60 naira. 300 units at 60 naira. So the total, the same quantity, 100, 300 at 50 naira, and this at 60 naira. So with a total of 500 times 50, 5,000. Then 300 times 60, 18,000. So the same total with this. So now we are dealing with LIFO, last in, first out. So the last to come into store will be the first to be issued out. So now let's look at it. In the question, after April 6th, what date comes next from the question? Hello? Hello, class? We have May 9th. May 9th. So on the May 9th, if you sum this up, you have a total of 23,000. And then this total, you have a total of 400. A total of 400. So here we have 29. We have 29 May. And on 29 May, sorry, not 29, on the 9th of May, on the 9th May, 9th May, 200 units was sold. 200 units was sold. At what price? We said last in, first out. So the last to be in store here is the 300 units. So it is out of these 300 units that these 200 will be sold out. And the price of 300 units is 16 naira. So these 200 that will be sold in May will be sold at 16 naira per unit. So 200 times 60. 200 times 60. 12,000. You have 12,000. And then here, you will remove the 200 that has been sold from your total balance. So from the 300 available stock, we will have 200 removed, 200 unit that is being sold. So we have a balance of 200 left. Have a balance of 200. Then in this, we are going to remove this since it's the unit sold. So it will reduce the amount in stock and the value in stock. So we'll have 23,000 minus 12,000. 33,000 minus 12,000 will give us 11,000. So we have 11,000 here. So the next thing, after 9th May, the next transaction is 14 July. 14 July, a purchase of 500 units, which is received in stock. So we have 14 July. The next transaction happens on 14th July. And the total unit is 500. The 500 units at the price of 17 naira each. 70 naira. So 70 times 500. 500 unit times 70 naira will give you 35,000 naira. So here we have an addition to the stock of 500 items with a total value of 35,000. So now we have 11 plus 35,000. 11,000 plus 35,000 will give us 46,000. 46,000. And here we have 200 items in stock plus the 500 unit that is received. We'll have a balance of 700. A balance of 700 unit in stock. Then after July 14, the next transaction is on July 25th. July 25th, 200 units was sold in July 25th. We have 25th July, 200 units sold. And it is on the basis of last in. So the last item that goes in is the 500 unit at 70 naira. So we value this at 70 naira. So 200 times 70. 200 units times 70 naira will have 14,000 naira. This is 200 sold. $200 sold out. We're going to remove it from the total stock we have since it has been sold out. Good. So this 200 will be sold out at 70 naira. 200 times 70 is 14,000. So we are going to remove this value, 14,000. So 46,000 minus 14,000. 46,000 minus 14,000. So what are we going to get? 46,000 minus 14,000. It will give us 32,000. We have 32,000. 32,000. Then next, after July 25th is August, is October 22nd. The next transaction happens on October 22nd. Purchase of 200 units at 80 naira. 22nd October. Purchase of 200 units. Purchase of 200 units at 80 naira. At 80 naira. So 200 units will be added to this. 200 times 80. 200 times 80 naira is 16,000. 16,000 naira. ₦16,000. Okay, so this is an addition. 32,000 plus 16,000 will give us 48,000. We have 48,000. 48,000. This is the balance. So here we have 700 minus 200. We'll have 500. That is the balance. Then 500 plus 200 will have 700. This is our the new value of stock inventory. Total unit of inventory now is 700. So after October 22nd, we have November 23rd, where 200 units were sold. November 23rd November, 200 units sold. 200 units sold. And this 200 unit that is being sold, the 200 units sold will come out from the last 200 that we received in stock, which is at 80 naira. Since it's last in, first out, 200 is 200 at 80 naira. Will give us 16,000. So it's out. Good. At 16,000. So the next thing after the next transaction after November 23rd is December 200 units sold. 200 units sold. This one too is issued out. This one is going out. 12th December, 200 units. So remember, we've exhausted these 200 for this 200 of October 22nd is the same 200 that we issue out that we sold out in November 23rd. So the most recent or current now, the last thing in this now is still what we have the balance is of this 200, 70 or this 200. So this new stock now, this new inventory will be sold at 70 naira. This one will go at 70 naira. So 48,000 minus 16,000. 48,000 minus 16,000 will have 32,000. So this is the balance of this. Then here we have 200 issued out. 200. We have 200 issued out at 70 naira. At 70 naira. So 200 times 70, we have 14,000. So 32 minus 14,000 is 18,000. So this is it. This is the LIFO last in, first out method. So any question? Any question on this? No question, I guess. So now, material purchase quantities. That is what we will be looking at next. Material purchase quantities, the economic order quantity, the EOQ. Economic order quantity, the cost associated with inventory. That's what we will be looking in our next class. Cost associated with inventory, the economic order quantity, also known as the EOQ. Purchase price of the inventory, reorder cost, cost of making orders to purchase a quantity of material item. The cost of delivery of the purchased item, the cost associated with pricing an order, cost associated with taking the inventory after delivery from the supplier, then batch set up cost if the inventory is produced internally. Then we'll look at inventory holding cost, cost of capital tie-up, insurance cost, cost of warehousing, obsolescence, or deterioration. So these are part of the inventory holding costs. Then the economic order quantity. So this is what we'll look at in our next class, next week. Any question on this, on what we have done so far? If no question, we will end the class here today. Then next week, we continue from economic order quantity. Okay. Thank you.